Welcome to the deep dive. Today we're going to be diving into Maximum Adverse Excursion.
Okay.
And, you provided this book, so It seems like you're really looking to get a handle on risk management and trading.
Yeah.
Especially when it comes to those sudden price swings, those heart-stopping moments.
Absolutely. And this book by John Sweeney, a seasoned trader himself, offers a really unique perspective on managing these price fluctuations.
Right.
We'll be unpacking this concept of maximum adverse excursion, or MAE for short.
MAE, okay. Got it.
And exploring, how it can help you make smarter trading decisions.
So this book is all about, analyzing price swings in crude oil from back in the 80s and 90s. Now, you might be thinking,
right,
what good is, old oil data to me?
Right.
Well, the principles we're going to uncover here are surprisingly timeless.
Absolutely.
And can be applied to any market you trade today.
That's an important point.
Yeah.
The principles are what matters.
Yeah.
The examples just bring them to life.
Exactly. So let's jump right into one of those examples.
Okay.
What really grabbed me was Sweeney's analogy about spooking a zebra herd.
Yes. That's a great way to visualize the unpredictable nature of the market.
Right. Imagine you're trying to scare a herd of zebras, expecting them to scatter.
Yeah.
But instead of running away as you planned,
right,
they decide to stampede right at you.
It's a powerful image.
Yeah.
And it really captures, how a trade that looks good initially can suddenly turn against you.
Oh, wow.
The market, like that zebra herd, it doesn't always behave the way we expect.
So how do we avoid getting trampled by the zebra herd of the market?
Right. That's where MAE comes in.
Okay.
Maximum Adverse Excursion, or MAE,
Yeah.
is simply the furthest a price moves against your position before it, potentially turns around.
Okay.
It's that moment of truth where you have to decide whether to hang on or cut your losses.
Okay, so let's say I buy a stock and the price starts to drop. How do I calculate the MAE for that trade?
So you would measure the biggest drop in price from your entry point to the lowest point it reaches before either bouncing back or hitting your stop loss.
Got it.
And you would do this for each and every trade that you take.
So it's not just a theoretical number, it's a practical tool we can use to understand our own trading pattern.
Precisely.
Yeah.
By tracking your MAE on every trade, you start to see a pattern in your trading system's behavior.
Okay.
It helps you understand your personal risk profile based on the specific rules that you're using to trade.
Now, to really visualize this, Sweeney uses something called frequency diagrams or histograms.
Yes.
Can you paint a picture of what these look like?
So imagine a chart where each bar represents a price range. Say $1, $2, $3, and so on.
Okay.
And the height of each bar tells you how many trades experienced an MAE within that range.
Got it.
So you can quickly see how often your trades move against you by a certain amount.
And what's really interesting is what this reveals about winning versus losing trades, right?
Absolutely. The data shows that winning trades tend to have smaller MAEs.
Okay.
They don't go too far against you before turning positive.
So this isn't just about understanding risk. It's about potentially identifying winning trades early on.
That's a great point.
Okay. And it also gives you a logical way to set your stop-loss orders.
Exactly.
Let's talk more about that in part 2.
Sounds good.
This is getting really fascinating.
Yeah, it is. So we've seen how winning trades tend to have smaller maximum adverse excursions.
Right.
Now, the question is, how can we use this information to, protect our capital and improve our trading?
Yeah, that's the million-dollar question. It seems like this could be a game changer when it comes to setting stop-loss orders.
Exactly. By studying your MAE data, you can identify the point where winning trades rarely get stopped out.
Okay.
This becomes your ideal stop-loss level, a kind of safety net that allows your winners to run while limiting your losses on trades that go against you.
Okay, so I see how understanding MAE can help me avoid those big losses. But doesn't setting tight stops also mean potentially cutting off some winning trades before they have a chance to really take off?
That's the trade-off, and it's a delicate balance. To visualize this, Sweeney introduces the concept of profit curves.
Profit curves? That sounds intriguing. Can you break that down for me?
So imagine a line that goes up when you win a trade and dips down when you lose.
Okay.
Now picture this line changing shape based on where you set your stop loss.
Got it.
That's what a profit curve shows you, the impact of different stop levels on your overall profit.
So it's like a visual representation of the risk-reward relationship.
Precisely. It helps you find that sweet spot between protecting yourself from big losses and giving your winners room to run.
Now, you mentioned that the examples in the book focus on crude oil.
Right.
But you also said that these principles can be applied to any market.
Mm-hmm.
What about volatility? Doesn't that kind of throw a wrench in the whole MAE calculation?
That's a common concern. You'd think wild price swings would make MAE less reliable. But Sweeney actually dives into this in the book. He analyzes how daily price ranges change after you enter a trade.
Okay, so he's looking at how the market's behavior might shift once you're already in a position.
Right.
What did he find?
What's interesting is that in the crude oil market, at least for the specific trading system he was analyzing, those wild price swings weren't as big of a factor as you might think, especially for winning trades.
So you're saying that even in a volatile market, winning trades tend to follow a certain pattern of behavior.
That seems to be the case, at least in the data Sweeney analyzed. But remember, every market and every trading system is different.
Right.
The key takeaway here is that you need to do your own analysis to see how volatility affects your specific trades. Don't just assume that you always have to widen your stops in a volatile market.
That makes sense. But let's face it, even with the best stop-loss strategy, we're all going to hit losing streaks at some point.
Sure.
How does the book address that?
So Sweeney calls this runs effects. Basically, analyzing the impact of those losing streaks on your trading capital. Nobody likes to think about it, but you need to be prepared for those inevitable rough patches.
Right, because those losing streaks can really eat into your profits if you're not careful. So how does he measure the potential damage?
He uses something called a drawdown calculation, which shows how much your capital could shrink during the string of losses.
Okay, I'm getting a little nervous just thinking about this, but it's important to understand the worst-case scenario, right?
Absolutely. Knowledge is power. And what's fascinating is that even with a relatively simple trading system applied to the crude oil data, those catastrophic losses were actually quite rare.
So there's hope, even for us mere mortals who don't have a crystal ball.
Exactly. It's not about eliminating risk completely, because that's impossible. It's about managing risk so that those inevitable losing streaks don't wipe you out.
Now, for those listeners who are feeling a little more daring, the book touches on a more advanced concept called martingale betting strategies. Can you give us a quick rundown of what that's all about?
So martingale betting is a strategy where you adjust your bet size after each win or loss. Essentially, you increase your bet after a loss and decrease it after a win.
Okay.
It's a way to potentially recover losses quickly, but it also carries significant risk.
It sounds a bit like doubling down at the roulette table.
Right.
Exciting, but potentially dangerous. Does the book go into detail on how this strategy plays out?
Yes. Sweeney explores applying martingales to his crude oil trading system. And while the results show the potential for higher profits, it's important to remember that this strategy also amplifies your risk.
Okay.
It's not for the faint of heart, and it definitely requires a substantial amount of capital to withstand those potential losing streaks.
So it's a high-risk, high-reward approach that needs to be approached with caution.
Exactly.
Up to this point, we've been focusing on analyzing individual trades.
Right.
But how do these concepts translate to the bigger picture of managing your overall trading or even a team of traders?
That's where the book really gets interesting. Sweeney provides a framework for using MAE information to evaluate not just individual trader performance, but also the effectiveness of different trading strategies.
So it's like taking those granular MAE insights and scaling them up to a macro level. Tell me more about how this works.
It's about recognizing that every trader has their own unique MAE profile.
Okay.
Based on their trading style and risk tolerance. By understanding this, you can assess whether their trading approach is aligned with their goals and the overall risk profile of the portfolio or fund they're managing.
That makes sense. Instead of just focusing on wins and losses, you're looking at the underlying risk dynamics of each trade.
Exactly. And you can apply the same principles to evaluating different trading strategies. By analyzing the MAE data for each strategy, you can get a clear picture of its risk-reward profile.
So this is about moving beyond simplistic metrics like win rate or average profit per trade and really digging into the underlying risk dynamics of your trading. This is a fascinating deep dive. Let's wrap things up and connect all these insights back to the listener in part 3. Okay, so we've covered a lot of ground in this deep dive into Maximum Adverse Excursion.
Yeah.
We talked about zebra herds, calculated, price swings, and even explored some pretty advanced betting strategies.
Right.
But what does it all mean, for the listener, like in practical terms?
Well, I think you hit the nail on the head when you said, those zebra herds.
Right.
It's about empowering you to take control of your trading.
Mm-hmm.
MAE analysis gives you a framework for quantifying and managing risk.
Right.
It helps you turn those, those scary price swings,
Yeah.
those moments where the market seems like it's running right at you, into calculated decisions.
So instead of just reacting emotionally to the market's, ups and downs,
right,
you can approach your trading with a more systematic and objective mindset.
Exactly. And it all starts with, understanding your own personal risk tolerance and your own trading style. MAE analysis provides the tools to really tailor your approach to your specific needs and goals.
Now remember, the examples in the book are specific to the crude oil market.
Right.
But you've also said that these principles can be applied to any market you trade.
Absolutely.
So whether you're trading stocks, futures, forex, or even cryptocurrencies,
right,
the key is to do your own analysis.
Exactly.
And see how MAE plays out in your specific trading universe.
That's the beauty of this approach.
Uh-huh.
It's not a one-size-fits-all solution.
Right.
It's a framework that you can adapt to your individual circumstances.
So as you continue your trading journey, we'll leave you with this final thought-provoking question to ponder.
Okay.
Could applying MAE analysis to your own trading help you navigate the zebra herd of the markets with more confidence and potentially even unlock new levels of profitability?
It's definitely worth exploring. Understanding MAE can be a powerful tool for any trader looking to, improve their risk management and overall trading performance.
Well, thanks for joining us on this deep dive into Maximum Adverse Excursion.
It's been fun.
We hope you found it insightful and, more importantly, actionable.
Absolutely.
Happy trading.
Happy trading.